You wake up, check your phone. Coffee's $7 now. Your rent went up again. Your friend just got laid off. The news says the economy is cooling. And somewhere in Washington, D.C., a group of people you didn't vote for just had a meeting and quietly decided the price of basically everything. No new law was passed. No election happened. Just a meeting. And a number. That number is the interest rate, and the institution that sets it is the Federal Reserve. Most people have heard of it. Almost nobody understands what it actually does. And that's a problem, because it affects your mortgage, your job, your credit card bill, your savings, and whether your boss is about to start making layoffs. So let's fix that. Fast. The Federal Reserve is the central bank of the United States. Created in 1913. It's not a government agency in the traditional sense. It's a weird hybrid. Part public, part private. It doesn't report to the president. It doesn't answer to Congress in any meaningful day-to-day way. It operates independently, which is either genius or terrifying depending on who you ask. Its official jobs: keep prices stable, keep unemployment low. That's it. 2 mandates, simple on paper, wildly complicated in practice. Think of it like a thermostat for the economy. Too hot, things overheat, prices spike, inflation runs wild. Too cold, businesses shut down, people lose jobs, credit dries up. The Fed's entire job is to keep the temperature just right. The problem is, the thermostat has a 6-month lag and the weather keeps changing. The Fed has a lot of tools, but one dominates everything else. It's called the federal funds rate. This is the interest rate at which banks lend money to each other. Overnight, banks are required to keep a certain amount of reserves on hand. Sometimes they're short, so they borrow from another bank. The rate they pay on that loan? That's the federal funds rate, and the Fed controls it. Now here's the key. That one number, the rate between banks, cascades through the entire economy like a ripple through water. When the Fed raises that rate, borrowing gets more expensive everywhere. Banks pay more to borrow from each other. They pass that cost to you. Your mortgage rate goes up. Your car loan goes up. Your credit card, APR, goes up. Businesses pay more to borrow money to expand, hire, or invest. So they do less of all three. When the Fed lowers the rate, the opposite happens. Borrowing gets cheap. Money starts flowing. People buy houses. Companies hire. The economy moves. One number, everything moves. Let's make this concrete. Say you're buying a house, $400,000. You're putting 20% down, so you're borrowing $320,000. At a 3% mortgage rate, which is roughly where rates were in 2021, your monthly payment is around $1,350. Over 30 years, you pay about $486,000 total. At a 7% mortgage rate, closer to where things went after 2022. That same loan cost you about $2,130 a month. Total paid over 30 years? Around $767,000. Same house, same loan amount, different Fed rate environment. The difference, nearly $300,000, just from the interest rate environment the Fed created. That's not abstract policy, that's your actual life. 8 times a year, a group called the Federal Open Market Committee, the FOMC, meets to decide what to do with the rate. It's made up of the Fed's Board of Governors, plus the presidents of regional Federal Reserve banks. They look at economic data, employment numbers, inflation figures, GDP growth, consumer spending, and then they vote. Raise the rate, lower it, or hold it where it is. When they announce their decision, markets move within seconds. Billions of dollars shift, bond prices change, stock valuations adjust, currency traders react globally, all from a press release. Jerome Powell, the Fed chair, as of this recording, holds a press conference after each meeting. His exact word choices are analyzed like ancient scripture by thousands of economists and traders worldwide. Once, markets dropped because of a single adjective he used that came across as more hawkish than expected. One word, billions of dollars. That's how closely people watch this thing. Here's why the Fed ever raises rates in the first place. Inflation means prices are rising. A little inflation, around 2% annually, is actually the Fed's target. It's considered healthy. It encourages spending now rather than waiting, keeps debt manageable, gives the economy room to grow. But when inflation runs hot, say 7%, 8%, 9% like the US saw in 2022, That's when things break down. Your $7 coffee? Partly that. Your rent? Partly that. The price of eggs, gas, plane tickets, everything. When inflation rips, your purchasing power erodes fast. A dollar buys less than it did a year ago, and then less again and again. The Fed's response to high inflation is to raise rates, make borrowing expensive, cool down demand. When things cost more to finance, people buy less. When businesses can't get cheap loans, they invest less. Demand drops. Eventually, so do prices, or at least price growth slows. The risk? If you raise rates too fast or too high, you tip the economy into a recession. Businesses can't afford to operate. Layoffs start. Your friend loses his job. The cure becomes the disease. This is called a hard landing. The Fed is always trying to avoid it. Let's talk about that. When the economy slows too much, unemployment rising, growth stalling, businesses pulling back, the Fed cuts rates, makes money cheap, encourages borrowing and spending, tries to stimulate activity. This is basically what happened in 2008 and again in 2020. Rates got cut to near zero. In 2020, the Fed also did massive asset purchases, buying government bonds and mortgage-backed securities to inject money directly into the financial system. This is called quantitative easing, or QE. Essentially, the Fed creates new money and uses it to buy assets, which pushes more cash into banks and keeps rates low across the board. Cheap money flooded the system, stocks surged, housing prices surged, everything asset-related surged. If you owned assets in 2020 and 2021, you felt great. If you were trying to enter the housing market or invest for the first time, you were being priced out in real time. The Fed's medicine for the recession made things dramatically harder for people who had nothing to protect yet. Here's the uncomfortable part. When the Fed lowers rates and pumps liquidity into the system, asset prices go up. Stocks, real estate, bonds. The people who own those assets, overwhelmingly wealthy people, get wealthier. This isn't a conspiracy theory, it's just math. Low rates inflate asset prices. Rich people own more assets. Therefore, loose monetary policy disproportionately benefits people who are already doing well. When the Fed raises rates to fight inflation, who gets hurt? People with variable rate debt, people trying to buy their first home, businesses with thin margins that rely on cheap financing, workers when companies start cutting costs. The Fed isn't evil, it's not targeting anyone. But the structure of how monetary policy works, through credit markets and asset prices, means its effects land differently depending on where you are financially. This is why people argue about the Fed constantly, and why understanding it matters for you personally. Here's a connection most people don't make. The Fed monitors unemployment closely. Too low unemployment, believe it or not, can actually be a problem in their model. Why? Because when virtually everyone has a job, workers have leverage. They demand higher wages. Companies pay those wages, then charge more for their products to cover costs. That pushes prices up. Inflation. So ironically, the Fed sometimes raises rates partly to cool the job market, to nudge unemployment slightly higher, to reduce wage pressure, to slow inflation. If you've ever heard the phrase, the Fed is trying to engineer a slowdown, that's what it means. They're trying to make conditions just uncomfortable enough that inflation cools without tipping into full recession. And sometimes, often, they overshoot. Rates go too high, too many jobs disappear. Recession arrives anyway. It's a brutal balancing act. Let's do a quick real-world case study because this stuff actually happened. During COVID, the Fed slashed rates to near zero and bought trillions in assets. Stimulus checks went out, people saved more, supply chains broke down. Demand surged while supply couldn't keep up. Inflation started climbing in 2021. At first, the Fed called it transitory, meaning temporary. It'll sort itself out. They held rates low. It didn't sort itself out. Inflation kept climbing. By mid-2022, it hit levels not seen in decades. The Fed responded with one of the fastest rate hiking cycles in its history. Multiple consecutive 75 basis point hikes. The federal funds rate went from near zero to over 5% in roughly a year. Mortgage rates doubled. The housing market froze. Tech companies laid off tens of thousands. Startup funding evaporated. Crypto collapsed. The stock market had its worst year since 2008. All of that traceable back to that one number, moving fast. The Fed operates independently from the government on purpose. The logic: politicians face elections. Elections create incentives to juice the economy short term, cut rates before a vote, print money, make people feel good, even if it causes long-term damage. Inflation, debt, bubbles. An independent central bank, in theory, can make the unpopular but correct long-term decisions. Raise rates even when it's painful. Not print money just because it would feel nice right now. But independence also means accountability is murky. Nobody voted for Jerome Powell. Nobody can fire him easily. A group of economists and bankers makes decisions that affect 330 million people's financial lives. And there's limited democratic recourse when they get it wrong. This is a genuine tension, not a talking point. Both sides have real arguments. Understanding the Fed helps you make better personal decisions. When rates are high, like they were in 2022 and 2023, locking in a fixed rate savings account or CD actually gives you meaningful returns. Cash isn't dead money in that environment. Meanwhile, taking on variable rate debt becomes more dangerous. When rates are low, like they were in 2020 and 2021, borrowing to buy assets, house investments, is cheap. But holding cash is slowly losing value. That's when sitting in a savings account genuinely costs you purchasing power. The Fed tells you the interest rate environment. The interest rate environment tells you what money costs. What money costs determines what every smart financial move should be. You don't need to predict the Fed, you need to understand the environment it creates and respond accordingly. All right, fast version. Everything you just learned. The Federal Reserve is the U.S. central bank, created in 1913, independent from the government. Its two jobs: stable prices and maximum employment. Its main tool: the federal funds rate. The rate banks charge each other overnight. That one rate ripples into every loan, mortgage, credit card, and business decision in the economy. The Fed raises rates to fight inflation, makes borrowing expensive, slows demand, risks recession. The Fed cuts rates to stimulate a slowing economy, makes borrowing cheap, risks inflation. 8 times a year, a committee meets and decides which direction to nudge. Markets move on their words. Your mortgage rate moves on their decisions. Your job security is partly a function of their calculations. When rates are low, asset prices rise, and the wealthy benefit most. When rates are high, debt gets painful and new buyers get frozen out. The Fed isn't perfect. It's wrong regularly. But it's the closest thing to an economy-wide control panel that exists. And now you understand how to read it. The next time you see a headline that says, Fed raises rates by 25 basis points, you'll know exactly what that means. For your mortgage, for your savings, for your job, for the stock market, for the economy. That's not boring financial news anymore. That's the thermostat moving. And now you know how to dress accordingly. If this video saved you from ever again nodding along to financial news you didn't understand, subscribe. It's free. Which, given everything we just talked about, is practically a miracle.